Want to say that again? Don't wear my glasses because I can't see this. Anyway, we've been talking about a Legg Mason paper that I referenced that I thought was interesting, which discussed 4 guidelines for making good decisions, and of course our interest here is in making good investment decisions. We've talked about the first 3 in previous videos, and today we're going to talk about the 4th guideline, which is the value of having a high awareness of the factors that can distort human judgment. We all have a tendency to fall into psychological traps. These traps reflect a mismatch between the kinds of problems that evolution designed our brains to solve and the actual challenges that we face today in the investment world. Things such as herding behavior, framing, overconfidence, anchoring to a position, and many more. So as an example, herding behavior is the tendency of people to want to do what everyone else is doing and what's popular. So in the investment world, that means that people would be interested and most comfortable owning in their portfolio the same securities as their peers, the things that are talked about favorably. But as you can imagine, if everyone owns them, there's no one left to buy them, and therefore it's very likely that their price is high and the return possibilities going forward are low and the risk is high. Whereas the contrarian investor who's able to free himself from that psychological force of herding may buy a security that the herd has left behind or hasn't heard of yet, and sit with that security at a low price and therefore low risk, waiting for the herd to discover it or rediscover it and move towards it, causing the price to rise, and then the kind of psychologically free contrarian investor would sell that security to the herd and take his profit and move on to the next unpopular thing. So it's an awareness of these psychological shortcomings of human beings that would allow one, it's the first step towards allowing one to manage their behavior and to create better investment results. So that's it. That's the 4th of the 4 guidelines discussed in the paper, and I think that if one has a good process, appreciates that investing is a long-term process, has a kind of manic joy and appreciation for trying to find things on sale, looking for good odds, and can control their one's kind of tendencies to be human, then you have the best opportunity, the best chance of creating good investment results.